Hello and welcome to our quarterly outlook video for Q3 2022. I'm Alex Leonida. I handle the investments here at CFG. There was a ton going on in the first half of the year. Now we're halfway through the third quarter, so some of this data is going to be specifically discussing first and second quarter, and then some of it's going to be a little more updated with some of the new data points that have come out over the last few weeks. So without further ado, let's get after it. Global markets, they've been everywhere. U.S. stocks have been absolutely atrocious through two quarters, but then they've bounced back pretty nicely over the last 6 weeks. This chart kind of gives you an idea of the volatility on the various indices here in the U.S., the S&P in purple, the Dow in that pretty orange color. We have NASDAQ in blue, and then small companies, the Russell 2000 in green. Tons and tons of volatility across the board, a little bit more stability in the big blue chippy names in the Dow. As projected in the last video, we were very specific in saying we thought Q2 was going to be rough, and it was. The start to Q3 has been much better, but we don't really expect this to continue either. So we're kind of projecting additional volatility into winter months, given the current policy stance of the Fed right now. While they're trying to get inflation under control, it could be too little too late on that front, especially because inflation is likely to kind of stabilize and disinflate a little bit or deflate a little bit as there's some demand destruction with this recessionary environment we are finding ourselves in right now. And we're going to dig into that a little bit with some additional data points later in the video. Moving on to international stocks, they provided very little stability to portfolios and relative diversification, considering how highly correlated they were to U.S. stocks through the first two quarters of the year. Even though the Ukraine war has not really come to a conclusion or doesn't seem like it's going to stop anytime soon, markets in general have stabilized a little bit over the last few weeks. This is kind of one of those things where we are thinking the market is perceiving there to be a bottom in, and all of the bad information, at least on the European front, has already been priced in. That all remains to be seen. The one bright spot for Europe, especially their export-driven economies, is the euro is essentially at parity with the US dollar right now, which hasn't happened really in about 20 years since the euro started. This should put a floor under an already weak market because it should stimulate some of the exports coming out of the euro area. I'm not going to spend too much more time on developed international, so if you want to get into the weeds on that, shoot an email over at info@cfgfinancialplanning.com. Moving on to China and emerging markets as a whole, they've been decent this year. China has been comically unpredictable per usual with their constant shutdowns and reopenings. It is our perspective right now that because China has been so broken in terms of their countrywide response to COVID, that we are seeing an opportunity in terms of rate of change for data to get sequentially better over the next 6 months to a year, which is not really hard to do when you're coming from zero when everybody's locked in their apartment. So with GDP numbers looking pretty bad, with demand and other highly important data points coming out of China looking awful during these lockdown periods, periodically through the first and second quarter, and even just most recently a couple weeks ago, rate of change on GDP, exports, PMI, industrial production, the whole 9 yards should sequentially get better, assuming the country doesn't lock down again, which, who knows? I'm not your guy on that one in terms of China policy. But if we look at all the data points that we were just kind of hammering on, unemployment rate, Chinese exports, the Chinese real GDP, obviously GDP is slowed over the last quarter because they were closed for most of the quarter. So it's a lot easier to get better from negative 2.6 than it is from positive 2.6. So in terms of rate of change, like I was saying, China could be in a bullish trajectory on some of this stuff as long as they don't shut the entire economy down again. In terms of bonds, they've been pretty stable over the last month and a half to 2 months, similar to equity markets. They're starting to recover a little bit. Most of this has to do with the bond market pricing in how many Fed rate hikes they're expecting. So with the recessionary data looking really aggressive at this point, and the fact that we are likely in a recession already, this is a scenario where the market is saying, hey, the Fed's going to stop hiking rates probably after another 4 or 5 25 basis point cumulative hikes. So we'll see what happens with that. The bond market's normally pretty good at predicting this stuff. One other important point is the 10-2 yield curve, or the spread between the 10-year and the 2-year Treasury. It's currently inverted about 45 basis points, which is a lot. And all you have to do is look at this chart and see every single one of these gray areas has been a recession. And each time, yep, you guessed it, the 10s and 2s inverted quite a bit. This is the most we've seen on an inversion back since right before the tech bubble burst in 2000. So not saying that this is going to be anything like that in terms of aggregate drawdown in the market, just flagging that this is a bit of a red flag. Sorry for the redundancy there, but truly, this is a red flag for the markets. And I don't know. I mean, we've already seen a bear market flash with S&P being down over 20, the NASDAQ being down over 30 at the lows. The bottoms could be in. We just aren't necessarily sure about that right now. So moving on kind of to a policy side of things and talking about what data points we're seeing right now. The administration's trying really hard to find ways to throw money at the economy, likely because there's elections coming up and they've been fighting for some of these bills to be passed for months and months and months, pretty much the entirety of the Biden administration. My job is not to spin a narrative. I'm just going to break down some data points here. And for all the people that are arguing that we're not in a recession, I'm just going to go by the book definition, which is 2 negative quarters in a row. And this chart shows 2 negative quarters in a row. Now, granted, it's not as bad as it was in Q1, but hey, it's still negative. So that's a recession. For but the jobs report last week was gigantic, people out there. Those were non-farm payroll numbers, and that data is outrageously volatile. I think it's more important to focus on things that are a little bit more stable. But in terms of stability, the easiest way to find that is going to be through the labor participation rate, because that shows how many people are actually involved in the job market in the entire country. Forbes was pretty quick to point out that there's been 623,000 fewer workers in the workforce compared to the pre-pandemic levels. And then if we kind of break all these numbers down even more, 384,000 of the jobs gained over this period have been part-time work or people working multiple jobs, which counts twice. And then also 279,000 people are no longer self-employed when they previously were. So these are not great numbers in terms of touting the jobs data as being kind of a backdrop for this not being a recession, right? They're a little bit hard to break down, and it's kind of important to get into the nuance of what's actually in the data points, knowing that theoretically some people could be counted a couple of times if they're working multiple part-time jobs. In terms of actual functionality of the job market, we're seeing unit labor costs go through the roof. That's this purple number on this chart. And then productivity per worker falling through the floor. That is a bad combination. We're not saying we want people to be overworked. I just think this might be a little bit of an argument for the whole work from home movement, at least across the country, not really working that great because companies have to pay people way more to do way less work. Those are not sustainable, or that is not a sustainable combination, I should say, at least not in the United States and the way that our capitalist economy has functioned for decades. Since the last 10 minutes have been kind of meh, mostly bad news, saying the markets haven't been great, fixed income hasn't been great, jobs aren't great, we have a recession, all that. I have some good news to share with you all. Our company CFG is super excited to announce that we are going fully independent. As you all know, we're a registered investment advisor, have been for a long time. So we're no longer going to be contractors of Raymond James. Not a ton is going to change for you all out there. We're just not doing that brokerage business moving forward. And we're currently in the process of reaching out to each and every one of you to discuss this. So if you have not heard from us yet, the call is coming soon. So rest assured, you're going to get all of your questions answered. I think we are excited, and this is an opportunity for us and also for you as our clients. So onward and upward for CFG and our client family. And remember, hope is not an investment strategy. Take care and enjoy the rest of your summer.